Good morning and welcome to Talk Tickers. It is Thursday, February 5th, 2026. And if you're looking at your terminal this morning, specifically at the managed care sector, you might be scratching your head a little bit. We're looking at the Cigna Group, ticker CI.
It is definitely one of those mornings where the headline numbers and the market reaction don't seem to speak the same language at first glance.
Right. Let's just set the scene. Cigna dropped their Q4 2025 earnings this morning. And if I just look at the guidance, the forecast for the year ahead, it looks light.
It does.
They came in under street consensus for 2026 on both revenue and EPS. In a normal market, you miss guidance, you get punished, you see red.
Usually that is the rule. Absolutely.
But today, the stock is trading around, $284.53. That is up roughly 4.7% from yesterday's close. Investors are buying this hand over fist.
They are.
So the mission for this deep dive is simple. Why is the market cheering for a guidance miss?
Because this isn't a story about a miss. This is a story about a relief rally. You have to look at the context. For like the last 2 years, this entire industry, PBMs, managed care, has been operating with a regulatory gun to its head. The FTC, Congress, the court of public opinion, everyone was threatening to blow up the business model. What we got this morning was Cigna saying, we have fixed the model, we have settled with the regulators, and we are still going to make a ton of money.
So it's a beat now, transition later situation.
Exactly. Investors are bidding up the execution and the clarity. The fog of war has lifted.
Okay, we are going to strip this earnings call down to the studs. No corporate fluff. We need to talk about the P&L, this massive pivot and how they actually get paid, the whole settlement with the FTC, and of course, we'll finish with a trade idea that is, frankly, a little aggressive.
A little.
But first, we have to respect the numbers. Give us the rapid-fire snapshot of the quarter.
Okay, so it was a very clean beat for the fourth quarter of 2025. Top line Q4 revenue came in at $72.47 billion.
And the street was expecting about $69 billion. So that's a huge beat.
A massive beat on volume, up 10% year over year.
10% growth for a company of this size is not a rounding error. That is significant velocity.
It is. And it flowed to the bottom line. Adjusted EPS came in at $8.08, comfortably beating the $7.88 estimate.
Yeah.
And if you zoom out to the full fiscal year 2025, they generated $275 billion in revenue and nearly $30 in earnings per share.
And I noticed they aren't just letting that cash sit in the vault. They were busy with the checkbook.
Very busy. They repurchased $3.6 billion worth of stock in 2025. That's nearly 12 million shares taken off the table.
Wow.
And for the dividend lovers, they hiked the payout to $1.56 per share payable in March. So shareholder returns are alive and well.
Okay, so the backward-looking numbers are great. Cash machine go brrr. But let's dig into where this money is coming from, because I think there is a misconception that Cigna is just an insurance company. You know, they pay your doctor bills, they collect premiums. But looking at this report, the insurance side looks kind of boring.
Boring is a polite word for it. It's stable, but it's not the growth engine. The real story, and the reason the stock is up almost 5% today, is Evernorth.
Evernorth. This is the services arm, the pharmacy benefit manager, the PBM.
Correct. Evernorth hit $36.3 billion in revenue for the quarter.
$36 billion.
That is up 20% year over year. Think about that. The insurance business is flat, but the services business is growing at like venture capital speeds.
20% growth on a base of $30 billion is insane.
Yeah.
What is driving that? Is it just more people taking drugs?
It is specifically which drugs they are taking. The star performer was specialty and care services, which grew 14%. And this brings us to the biggest tailwind in healthcare right now, biosimilars.
Okay, let's unpack biosimilars. We hear this buzzword a lot. It sounds like a generic drug, but fancier.
That is a fair simplification. Think of a drug like Humira or Stelara. These are complex biologics, living cells, very expensive to make. And for years, they were protected by patents. They cost thousands of dollars a month. Well, those patents are falling off a cliff. Biosimilars are the generic versions of these complex drugs. They do the same thing, but they are much, much cheaper.
And Cigna is capitalizing on this switch.
Aggressively.
Right.
Script growth was up 13% year over year, and a huge chunk of that is Cigna moving patients from the expensive brand name drug to the cheaper biosimilar.
But wait, usually if you sell a cheaper product, your revenue goes down. If I sell a generic knockoff instead of a Gucci bag, I make less money. How is Cigna growing revenue by 20% while selling cheaper drugs?
That is the magic of the PBM volume game. They are incentivizing the switch so heavily, specifically, they launched a zero out-of-pocket offer.
Ew.
Zero. If a patient switches to the biosimilar, they pay $0.
So the patient runs to the window because it's free.
Precisely. Volume explodes. Cigna captures a fee on every single one of those scripts.
Yeah.
They also own the specialty pharmacy that dispenses it. So even though the unit price is lower, the sheer volume of people switching, plus the clinical fees they charge for managing that switch, drives massive growth.
So they're the toll booth operator.
They are effectively the toll booth operator on the bridge from expensive brand name to cheap generic. And traffic is booming.
That makes sense. They're monetizing the migration.
Oui.
But this brings us to the more controversial part of the Evernorth story, the business model pivot. We have to talk about how PBMs get paid, because for the last decade, it has been a total black box.
It has been the rebate model.
Right. And everyone hates it. The government hates it. Patients hate it. Explain how the old model worked, because I want to understand what they're actually changing.
So in the old model, a drug company sets a high list price. Cigna, as the PBM, negotiates a secret rebate to get that drug on the formulary.
Okay.
Cigna keeps a chunk of that rebate as profit, that's called spread pricing, and passes some back to the employer. It was opaque. You never knew if Cigna was pushing a drug because it was the best medicine or because it had the fattest rebate.
It was an arbitrage game. You're just playing the spread.
Exactly. And the FTC and Congress essentially said, stop doing this or we will destroy you. So Cigna is pivoting. They are launching a rebate-free model starting in 2026 and fully rolling out by 2027.
Okay, so the new model is transparent. How does that work?
It is fee-based, yes. Instead of secret arbitrage, they charge two things. One, a core administrative fee per member or per script, just a flat fee for doing the paperwork.
Right.
And two, performance fees for clinical outcomes.
Here is where I get skeptical. I'm looking at the transcript, and CEO David Cordani is basically telling investors, hey, don't worry. We're going to completely change how we make money. We are going to stop taking these lucrative rebates, and our profit margins are going to stay exactly the same.
It does sound like a magic trick, doesn't it?
It sounds like wishful thinking. How can you strip out the spread and still keep the margin? Why is the market buying this trust me story?
Because they are trading margin rate for guaranteed volume. In the old model, you had inventory risk and pricing risk. In this new model, Cigna takes zero inventory risk. They're just a service provider getting paid a fee. It's a lower risk revenue stream. And management is arguing that by adding these clinical performance fees, basically charging extra for managing things like cancer care or diabetes outcomes, they can make up the difference.
So they are betting that they can upsell services to replace the lost rebates.
That is the bet. They call it the 10 to 14% long-term earnings growth algorithm. They claim it stays intact. The market is giving them the benefit of the doubt today because, look, Cigna has a history of executing well. But you are right to be skeptical. 2026 is the transition year where we see if the math actually works.
And they're eating their own cooking first, right? I saw that in the notes.
Yes. In 2027, Cigna's own insurance arm fully adopts this model. By 2028, they expect 50% of external clients to convert. So they have about 18 months to prove it works internally before they have to sell it to the world.
Speaking of things that could have blown up the company, we need to address the FTC settlement. This news dropped literally 24 hours before the earnings call.
Talk about masterful timing by the investor relations team.
The headline number is $7 billion. $7 billion. When I see a company agreeing to pay $7 billion in a settlement, I usually think, ouch. But the stock went up. Explain that.
Because the devil is in the details. This is a global settlement covering the insulin price-fixing lawsuit and the PBM investigations. But Cigna isn't writing a check for $7 billion to the U.S. Treasury.
It's not a fine.
No. It is $7 billion in consumer relief over 10 years.
What does that actually mean, consumer relief?
It means Cigna is promising to lower out-of-pocket costs for customers by that amount. But here's the kicker. Under the new rebate-free model we just discussed, prices were going to come down anyway.
Wait, what?
They were already planning to pass those savings on to the consumer to drive volume.
So they took a business strategy they were already executing, slapped a $7 billion sticker on it, and handed it to the FTC as a settlement.
Essentially, yes. It is value transfer to the customer, not cash out of the balance sheet. It's a coupon, not a penalty. And by doing this, they made the sword of Damocles, the threat of a massive antitrust breakup, disappear. Cordani called it resolved.
That explains the relief rally. The worst case scenario is off the table. But there was one little nugget in the Q&A about this settlement that I found fascinating. The Swiss move.
Ah, yes. The group purchasing organization.
Break this down for us. What is a GPO and why was it in Switzerland?
A GPO is the entity that actually aggregates all the buying power to negotiate drug prices. And Cigna had theirs based in Switzerland. Why Switzerland?
Let me guess. Low taxes.
Low taxes. And secrecy.
And now they're moving it back to the U.S.
Part of the settlement and the realignment is bringing that GPO onshore. Financially, this is actually a negative. It is expected to raise their effective tax rate by up to 1%.
Which is a real hit to earnings.
It is. But think about the optics. You cannot have your secretive pricing unit hiding in the Swiss Alps while you are under investigation by the U.S. Congress for high drug prices. Bringing it home is a political tax. Management says it's manageable, but it shows you how serious they are about cleaning up the regulatory image.
It's the cost of doing business. Okay, we've covered the exciting stuff, Evernorth, the pivot, the legal drama. Let's briefly touch on the boring side. Cigna Healthcare. The insurance business.
It was fine. Revenue was $11.2 billion. Membership is flat at 18.1 million. But the headline here is margin overgrowth.
They are shrinking the business on purpose.
In certain areas, yes. Specifically, the individual exchange business think Obamacare plans.
Yeah.
They are letting membership drop below 300,000 lives. They looked at that market and said, we can't make money here.
So they just walked away.
They raised prices, people left, and Cigna said, good riddance.
That is disciplined. A lot of companies chase growth just to show a bigger top line. Cigna is saying, if you aren't profitable, we don't want you.
Exactly. And you see that prudence in their medical care ratio, or MCR. This is the percentage of premiums they spend on actual medical care. It was slightly elevated in Q4, but their guidance for 2026 is 83.7% to 84.7%.
That seems, well, conservative.
It is conservative, and that is why investors like it. Other insurers have been coming out and promising low MCRs, then getting hammered when flu season is bad or people get more knee replacements than expected. Cigna is assuming costs stay high. They are building a buffer.
Right.
The market loves a management team that sets a low bar and steps over it, rather than setting a high bar and tripping.
Which brings us to the final verdict on the numbers, the guidance. 2026 adjusted EPS of at least $30.25. The street wanted 30.36 cents. Revenue forecast $280 billion. Street wanted $283 billion.
A quality beat followed by a prudent miss.
Is that a fair summary?
It is. They are acknowledging that 2026 is messy. They have the friction of the PBM change, the tax hit from the Swiss move, and the shedding of those insurance members. But they are still promising to earn over $30 a share. The visibility is there.
And before we get to the trade, I have to mention the GLP-1 strategy. We can't do a healthcare episode without saying Ozempic or Wegovy. How is Cigna handling the weight loss craze?
They are playing the gatekeeper role. They have a program called Enrich RX. Basically, they go to employers who are terrified of the cost of these drugs and say, we will manage this for you. We will put a cap on your spending growth, and we will ensure only the people who really need these drugs get them.
So they're turning the biggest cost driver in the industry into a service product.
Exactly. They aren't just paying the claims. They are charging a fee to manage the chaos. It's classic Evernorth.
Okay, I think I have the picture. The regulatory cloud is gone. The business model is pivoting to something more sustainable, even if we are skeptical about the margins. And the services engine is roaring thanks to biosimilars.
That is the thesis.
Which brings us to my favorite part of the show, the part where we stop acting like responsible analysts and start thinking like hedge fund managers. It is time for This Is Not Financial Advice.
Please read the disclaimer.
You know the drill. We are not registered investment advisors. This is for entertainment only. If you bet the farm based on a podcast and lose, do not email us. We are just two people looking at a ticker tape.
So what is the play?
I'm calling this the biosimilar bounty hunter.
I love a good bounty hunter analogy. Who are we hunting?
We are hunting big pharma, specifically the legacy biopharma companies. Here's the setup. David Cordani mentioned on the call that there is $100 billion with the B in savings coming from biosimilars in the next few years.
That is $100 billion that used to be revenue for drug manufacturers.
Correct. That money has to go somewhere. It is leaving the pharma P&L and entering the PBM ecosystem. So here is the trade. You go long Cigna, CI, and you go short a basket of companies facing these patent cliffs. I'm talking about the makers of Humira, Stelara, and the next wave of biologics losing exclusivity.
So you are betting on the transfer of margin.
I am betting on the Grim Reaper. Cigna, via Evernorth, is the executioner. Every time they switch a patient to a $0 copay biosimilar, the pharma company loses a high-margin sale. But Cigna gets paid a volume fee and a clinical service fee for removing that patient.
So Cigna doesn't care which drug you take.
Not at all, as long as they process the transaction. But the pharma company relies on that brand loyalty. Cigna is actively destroying that loyalty.
It's ruthless. Cigna is effectively the toll booth, and they just decided to let the generic cars through for free while blocking the luxury cars.
Exactly. And here's the wild kicker. If you want to leverage this, you look at calls on Cigna for 2028.
2028, that is a lifetime away in this market.
It is. But remember the adoption curve. 2027 is the year the internal book converts. 2028 is when 50% of the external world converts to this new fee model.
And you think the new model is better?
I think it might be more profitable. Think about it. If they automate the clinical side with AI, which they hinted at with their digital engagement numbers, and they take zero inventory risk, their margins could actually expand. Everyone is worried margins will compress. If they expand, even by 50 basis points, the stock re-rates massively.
That is a true contrarian bet. You are betting that the trust me story is actually a just you wait story.
Exactly. Catch the savings, kill the pharma margin, leverage the model shift, the biosimilar bounty hunter.
It is aggressive, but the logic holds up. The $100 billion has to go somewhere. Cigna has the biggest bucket to catch it.
All right, let's wrap it up there. To recap, Cigna delivers a high-quality beat. The stock is up almost 5% because the regulatory nightmare is over and the transition plan is clear.
It won't be a straight line. The next 18 months will be noisy as they rewire the machine, but the relief rally is real.
Keep your eyes on the ticker, and we'll catch you on the next earnings sprint.
Good luck out there.